On paper, the financial markets are telling us one story, a story of relative calm. But if you know where to look, in the real world, where actual physical assets change hands, a completely different and, frankly, a much more urgent story is being written. Today, we're going to pull back that curtain on this great disconnect and figure out what these markets are really trying to tell us.
So, we have to start with a question that, in today's globally connected world, really shouldn't even exist. We're all taught that price is price, right? An asset is worth what it's worth no matter where you are. But what happens when that fundamental law just breaks? What does it mean when the exact same ounce of silver has two completely different prices at the exact same time? This isn't some market glitch, folks. It's a signal, a huge signal that something profound is shifting right under our feet. Okay, look at this. This slide just lays it all out perfectly. In the West, you've got the COMEX paper futures market saying an ounce of silver is worth 84 bucks. But head over to the East, to the Shanghai physical market, and they're paying $96 for that exact same ounce. That's a gap of almost 15%. That's not a rounding error. That is a massive chasm opening up between a paper promise and physical reality.
And here's the kicker. This isn't just random market noise. The gap is actively getting wider. I mean, just a few trading sessions ago, it was 13.5%. Then it went to 14%. And now, here we are pushing 14.6%. This is a clear one-way trend, and it's screaming at us, telling us exactly where the real urgent demand for physical metal is coming from. So the billion-dollar question is, who's doing all this buying? Well, to answer that, we've got to follow the trail. Not the trail of paper contracts, mind you, but the trail of actual physical metal being pulled out of vaults. And what we find, well, it's pretty counterintuitive. And this is where the story takes its first really sharp turn. See, in most rallies, what do you see? You see a frenzy of retail investors, right? The little guy piling in, chasing the price higher. But this time, they're completely absent. The typical Western retail buyer is just sitting this one out. So if they're not buying, who on earth is? And here's the hard evidence. Just look at the Sprott Physical Silver Trust. It's a super popular way for investors to get exposure to silver. Right now, it's trading at a nearly 6% discount to the value of the actual silver it holds. Now, get this. Back in the 2011 rally, it traded at a massive 17% premium. A discount tells you that investors are selling, not buying. This proves without a doubt it is not Western speculation driving this train, something else is. So while the retail crowd is on the sidelines, a much quieter and frankly, much more powerful group of buyers is stepping into the game. And these aren't speculators chasing a hot trend. No, these are strategic players who are acquiring the physical asset itself. We are literally seeing professional buyers pulling physical bars out of the COMEX exchange every single day. We're seeing big institutional players taking consistent delivery week after week. And this connects to a much bigger picture. Eastern central banks are in the middle of a long-term structural reallocation of their reserves, moving away from paper and into hard assets. I mean, just look at the People's Bank of China. For 16 consecutive months, without a single break, they have been adding gold to their reserves. This isn't some tactical trade. This is a deliberate, strategic shift of wealth, and it's the backdrop for absolutely everything we're seeing in the silver market. Now, of course, none of this is happening in a vacuum. These financial tremors are directly connected to the seismic shifts we're all seeing on the global geopolitical chessboard. Let's take a look at how these pieces all fit together. I mean, let's face it, the world is on edge. Conflict in the Middle East is getting worse. The critical Strait of Hormuz is basically a no-go zone for Western vessels. And now Qatar, which supplies about a fifth of the world's liquefied natural gas, has shut down a major facility. This isn't just headline risk. These are real structural shocks hitting the global energy supply. And the result? Take a look. Oman Crude, which is the key benchmark for all the oil flowing into Asia, has already ripped past that critical $100 mark. This isn't just a number. It's a massive inflationary pressure cooker being turned up full blast on the global economy. There's a pretty fascinating theory about how this whole system works. It basically says that these energy crises act as a kind of silent global tax. First, conflict makes oil prices spike. And because oil is priced in dollars, every country on Earth needs dollars to buy energy, which creates this constant global demand. That capital then flows back into U.S. financial markets, funding the very system that created the structure in the first place. It's a powerful feedback loop. And hey, if you're getting some value out of this kind of analysis, do me a quick favor and hit that like button and subscribe so you don't miss where this story is headed next.
But you know, beyond all the physical demand and the geopolitics, there is a secret hidden deep inside the market's plumbing. A mechanism that has been in place for decades, containing the price of silver, is now for the first time actually starting to break down.
And this is the absolute crucial point. For years, a massive force has been able to suppress real price discovery in the paper markets. But that force is now losing its structural capacity to do so, and the implications of that are just enormous. And here is the smoking gun. For the first time in literally decades, silver is no longer the most heavily shorted commodity. Just look at this shift. The big commercial traders, the ones who have historically placed these massive bets against silver to cap its price, they are aggressively covering their positions. They are getting out of the way. Just let that sink in for a minute. The single most reliable, most powerful source of artificial selling pressure in the entire silver market is structurally leaving. The cap is coming off, and not because of some temporary news event, but because of a multi-year trend of these big players unwinding their positions. So what all this does is set up an inevitable collision, a collision between two competing forces, the legacy paper price and the undeniable reality of the physical world. Now, look, to be fair, the bear case is still out there. The argument is that paper markets can still dominate in the short term, and the massive leverage on the COMEX can be used to smack prices down. But the physical case is just built on a much stronger foundation, a structural supply deficit, that historic short covering trend we just saw, and a world that is at a record level of uncertainty. And this, right here, is the ultimate takeaway for anyone trying to wrap their head around this. The tension between a paper promise and a physical reality, it doesn't just resolve itself slowly and gently. History shows us it doesn't close in a straight line. It closes in an event, suddenly and often very disruptively. Which leaves us with one final, critical question to chew on. In this great disconnect, when a paper promise and the physical reality of an asset diverge this dramatically, which one is ultimately forced to break?